inflation rate at the end. First of all, you will try to understand what is the theories of monetary policy transmission mechanism, and the most important topics that we will cover today is which are the channels of the monetary policy transmission mechanism. Think interest rate is here, inflation is here. From here to here, there are 4 channels to affect the inflation via the interest rate changes. And those channels are called as monetary policy transmission channels. And while doing so, we will focus on the implementation of the monetary policy as well. Then we will cover the summary of the topics. This is the best well-known transmission mechanism channels and implementation of the monetary policy. Please look at this chart. On the left-hand side, you will see the official interest rate. We will call generally, if it is central bank rate, we will call it as policy rate or official. Okay, today it is 5.5 for the United States, 4.75 for the European Central. This is the official interest rate that the central banks funding the market. Okay, so from this rate, every private or investment bank have a right to determine their own interest rate as well. But as you know directly, this is the lowest interest rate that you can borrow the money because it is coming from the highest authority in the government. It is the central bank. And it is the cheapest money because central banks printed the money, distributed and funded the market. For that reason, it is the cheapest rate that you can find money. Above that rate, you can put your deposit rate. You can put your loan rate as well. But for now, you should understand that the official rate is the policy rate of central banks. And from this policy rate, as you see here, this is the policy rate. And here we have the inflation. And how this policy rate will change the inflation rate via these 4 channels, 4 mechanisms. These are market rates, asset price channel, expectation channel, and exchange rate channel. We will try to cover all those things separately, and you will understand how this mechanism works and how will people change their expectation, change their consumption, change their saving decision according to this interest rate. Then the inflation at the end will change accordingly. As you see here, these 4 channels, the monetary policy transmission channel here, directly affect the domestic demand and external demand. So these 2 interest rate and 4 channel directly have effect on domestic demand first and external demand, the rest of the world at the end. Then from domestic and external demand, we will have the total demand. And please keep in mind that inflation generally coming from 2 sources. First, demand-driven inflation, and second, supply-driven inflation. And generally, the central bank's monetary policy can only control the demand side because demand side is about consumption, demand side about the expenditure or the investment. But what we call the supply side is this. For instance, the domestic inflation, let's say in Ghana or Kenya, can be affected by the prices of the gasoline, the prices of the energy, right? Petroleum products. So if there is a shock in the Ukrainian and Russian war, and if the petroleum prices rises, this is a supply shock, and central bank cannot control this. Whatever the Federal Reserve do, they will not decrease the prices of the petroleum products. Okay, the supply shock is uncontrollable. So central banks generally control the total demand function. They are focusing on to decrease the demand function. So you should also keep in mind that despite a decrease in the total demand, if the supply also decreases too much, the prices can increase again. First, you should understand the demand and prices. If you increase demand, price increase, right? So if the demand decrease, price and inflation should go down. But despite the demand decrease, maybe sometimes there is a huge supply shock higher than the demand. Then, despite the decrease in demand, inflation goes up because it is coming from the supply side shock. You should keep this style in this version. Then, from the total demand, we have the domestic inflation pressure. And from the exchange rate effect, we have the external inflation pressure. And from exchange rate to inflation, we called it as exchange rate pass-through effect. What does this mean? This means that, let's say, in my country, the Turkish lira, or let's say, in the Russia, it is the Russian ruble. If the Russian ruble depreciate against the United States dollar, and if the Russia import lots of products in terms of the United States dollar, then the prices of these products will be higher because USD is higher than before. For that reason, those increase in USD, meaning your currency depreciation, this exchange rate effect, will also increase the prices via import. For that reason, inflation can also come from the exchange rate effect. And this is called as exchange rate pass-through effect throughout the world. And this is coming via the import prices. But normally, domestic prices can change via the total demand. And it is coming from the asset prices, market rates, and expectation for the future effect. Please try to focus on the chart on this theories of the monetary transmission mechanism, the demand side. Let me explain this first. The central hypothesis is here. The difference between demand and supply drive the inflation. This is our basic dynamics. So if we have excess demand in the market, meaning that demand is higher than the supply, excess demand we have, the prices will go up. We will see the inflation. Basic structure is this. All participants should understand that if we have higher demand than the supply, the prices will go up. Excess demand meaning inflation. As you see here, difference between demand and supply drives the inflation. And monetary policy cannot affect the supply. Keep this in mind. Again. The monetary policy just focus on the demand side inflation. Okay, we cannot control the supply side. If there is a war in Ukraine, if there is a supply chain blockage because of the COVID-19 crisis, if the ships from the California to Shanghai cannot reach to those places in 2 months, these are the supply side shocks. And we cannot solve this problem via monetary policy. These are coming from the supply side shocks. Monetary policy rather focus on the demand side. So monetary policy cannot affect the supply or potential output, long-run neutrality of time. And the monetary policy can affect the demand side inflation, mainly through the interest and exchange rate policy. And lastly, keeping demand aligned with the supply is central task for the monetary policy. So what we say, if the demand go higher more than the supply side shocks, meaning we have excess demand, that will be inflation. If the demand is less than the supply side shock, then we will have deflation. So central banks does not want to both of the sides. Huge inflation, huge deflation. So our main target is to put the demand aligned with the supply. So there will be a price stability. Price should not go up and should not go down so much. So everybody around the world supposing that inflation is really bad things. Prices should decrease. No. In Japan, in China, prices are decreasing. There is deflation in those economies. And their central banks also started to solve the deflation problem. So we don't want to both of things, inflation and deflation. Inflation is prices going up. Deflation is prices going down. I need the prices stable in this line. Price stability. Okay, inflation targeting meaning price stability in the market. As you see in the graph here, this is the trend of the growth. And if the country's growth rate above the trend, it is positive output gap. There is inflation. If the country's growth rate is less than the actual and overall average growth, then there is deflation. So my aim is try to put the prices here, here, and here. Okay, it should be on the line. It should not be below or above the line. That if there is a stability in the price, it should be along with the line. And if we try to investigate what is the demand factors in the market, what are the main demand factors in your countries? What can you measure demand condition in your countries? For instance, if you focus on the monetary demand, let's say today the interest rate is really high. Let's say interest rate like in Turkey, it is 45%. Today in Turkey, interest rate is 45%. In Argentina, it is 75%. So as a household, Dr. Walchin, if he lived in the Argentina, will he go to the bank and apply for a mortgage loan? No, because if he gets $1 million with 75% of interest rate, he will pay at then $10 million, right? Because 75% interest rate, and during 10 years, it will be above 10 times high, the initial money. So if the interest rate is high, there will be no consumption, no investment decision in the market. So we will try to understand what are the factors that is affecting the demand side of the inflation. First, we will focus on the monetary view of the monetary transmission mechanism. Keep in mind we have one of the best well-known monetarist economists, the Oliver Blanchard and Kiyotaki. They are saying that central hypothesis is this. Difference, look at the sentences here. Difference between money demand and supply drives the inflation. So if there is a huge demand in the money, then if people have lots of money in their pocket, they will not save them. They will consume that because the prices of money is really cheap. If they consume and spend those lots of money in their pocket, then the demand increase in the market and the price is going up. The result will be the inflation. And they are saying that because the main driver of the inflation is money demand, so monetary policy can control the money supply. Because if I don't give the money, because who is controlling the money supply? Central bank. Because he is the only authority can print the money, right? If central bank does not print the money and does not fund the market, there will be no money in the market. So via controlling the monetary supply in the market, I can control the inflation rate and money demand. And if I control the money supply, then money demand will be stable because everybody, if there is no huge money in the market with cheaper prices, you should spend those money just for your necessary things. For instance, if you have just a small money in your pocket, you will buy food, water, and something like this, basic subsistence level. But if you have huge money in your pocket with cheaper prices, then you will go to the holiday. You will buy even an airplane because the prices of money are really cheap. So money demand, if I control the money supply, money demand will be stable. I will spend money only for my necessities. Then as you see here, keeping the money supply aligned with money demand is central task for the monetary policy. So I should keep in mind that I should try to control the money supply in the market, and my ultimate target will be to put an aligned demand of money and supply and money demand. So collaboration between money demand and money supply, if stable, then at the end, we will reach the price stability and inflation. So if the prices is stable, there will be no inflation in the market. Okay, so to fight with the inflation, my keyword is price stability. And price stability coming from the controlling money supply, because money demand is stable in this case. Then if I control the money supply, then there will be no cheaper money in the market, and there will be no huge demand in the market, and prices will be stable, and I will control the inflation. Please look at the picture here. This is a well-known picture after the Second World War. During the Weimar hyperinflation epidemic, a wheelbarrow full of paper money could only buy a single loaf of bread. Do you see the money in this bucket? This is only buying one slice of the bread, because there is a hyperinflation after the First World War in the Germany. Okay, so if the money supply increasing, do you see money supply is increasing, the prices is going up. So you should control the money supply in the market to control the inflation in overall. And let's come in the money demand side. There is a basic equation here, but don't afraid from it. It is a basic mathematical equation for the money demand function. And here, as you see here, what is the basic triggering point of who demands money for what reason? As you see here, the private sector holds money for what? To finance economic transactions, because they have lots of payments and there are lots of receiving the money. So they should finance the economic transaction. And they should save the money because they have investment in the future. They should have some save in their pocket. And to hold the liquid asset. Why? Because, for instance, if you have a house is illiquid, right? It is a real estate. If you need money urgently, that house cannot be converted in money in 1 second. But if you have gold, if you have treasury bond or something like that, it can be converted as banknote money, liquid money in 1 second. So to hold liquid asset, to save the money and to finance their economic transaction, the private sector holds money in their accounts. And demand for money, please look at this sentence. Demand for money depend on 4 things here. The real output, meaning gross domestic product of the economy, GDP. Okay, it is generally shown in Y, in economics. This is the economics of overall economy, gross domestic product. The prices, nominal money demand, and this is generally shown with P. Payment, technology, financial sector development. It is not in the demand function, but you can also think that transaction coming from the financial sector via technological infrastructure. And lastly, the interest rate. This is I. So money demand is a function of 3 things. Okay, here in money demand function, I have 3 variables. One is my income. It is my gross domestic product. Gross domestic product for country, but for the person, it is an income. And the prices and the interest rate, the cost of the money. So if I know these 3 things, I can understand how the money demand function will evolve in the near future. And one of the most important topics you should keep in mind while calculating the money demand function in the long run, it is the velocity of the money. It is in the supply function of the velocity, and you should understand and keep in mind this in this world. This is the Fisher equation, quantity theory of the money. Okay, quantity theory of the money around the world, known as the basic Fisher equation. And this is generally calculated by, please look at this sentence, quantity theory of the money. And velocity provides a link between broad money and the GDP. Okay, broad money is money, and the GDP is here the Q. Okay, here is Y, but now it is Q. And then if I write the quantity theory of the money here, it is calculating this. Money times velocity, M is money supply. Velocity is how many times the money change at hand. Okay, velocity is this. How many times I'm changing the money with hands, with transaction. I'm paying to Dr. Walchin, Dr. Walchin paying to Bernard, Bernard paying to Ismail. So how many times this money changing at hand? This is the velocity. P is the price level. Q is the economic activity, GDP. And P times Q is nominal GDP. And as you see, this M is money supply, and the velocity can be written as P times Q over M. If I divide each side to M here, this M gone, and P times Q over M, as you see here, this is basic equation, basic division. The velocity equals this. So if I know the GDP, and if I know the money supply, and I can know both of this because GDP is gross domestic product and easily followed by the transaction, and the money supply directly monitored and followed by the central bank. They know how much liquidity they are given to the market. So velocity of money is the frequency at which 1 unit of currency is used to purchase domestically, produce goods and services within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. How many times money changing at hand? Example, amount of money, the M, money supply, is let's say 1,000 kip. And economic transaction GDP are 2,000 kip within a year. So velocity will be 2, meaning that with 1,000 of money, if I produce 2,000 products, this means that money changing 2 times at hand. Okay. And this M times V is nominal monetary expenditure. So how to buy goods and services, to buy goods and services in the market, you need the money. So if those services and goods calculated as the GDP, to buy those goods and services, I need the money. And this should be equal. So nominal expenditure of the money will be equal to my money supply. Overall, at the end, it will be equal to the nominal gross domestic product of the country. And quantity theory says that here, quantity theory of the money says that nominal monetary expenditure, this is M times V. These have to equal the nominal level of expenditure resulting from the economic transaction, this is P times Q, meaning the nominal gross domestic product. This is an identity that has to be true by definition in any case. So this is not true in one country or not wrong in one country. This is true in everywhere. Okay, so if I come to here and if I try to see how does money demand and velocity can affect the prices of inflation, let's look at the circulation of the money in this cycle. This is household sector, this is public sector, and this is business sector. Households, if they have money, they have two cases. They have either consume or save, right? If you have money, you will either consume or save and invest. And from this disposable income of the household, the public sector can put taxes because government has a right to put taxes or decrease the taxes. And this disposable income can be changed between public sector and household sector via the transfers of the taxes. Okay. And when the saving come to the financial sector, they will make an investment with the saving, right? If you save the money, then you will buy FX, you will buy gold, you will buy bonds, you will buy stock exchange. So this will be your investment. And the government also spent the money. As you see here, transfer and taxes are their basic consumption levels. And from the business sector, if I put the national income, then from the rest of the world also we have, if this is a country, I have exports, which I am doing to the rest of the world, and I have imports, which I am doing from the rest of the world. So if I collect all these things, consumption, investment, government expenditure, export, and minus import, I will be at hand the gross domestic product. Okay, basically, gross domestic product is the sum of this: consumption, investment, government expenditure, export, minus import. Okay, this is your gross domestic product in your country. And now we are going into the details of the kitchen. Please remember the first slide. Market rates, asset prices, expectation, and exchange rate channel. These are the four channels that the monetary transmission mechanism, interest rate, can affect the inflation rate via this channel. So let's go into the details of this channel, how they are working. First of all, for the monetary transmission channels, the first one is the exchange rate. And the central hypothesis throughout the exchange rate is saying this. The real exchange rate matters for demand formation, meaning that if there is a real exchange rate in the market, this will directly affect our demand in the domestic economy. And the real exchange rate also matters for competitiveness of the external sector. So if, let's say, you are using the Russian ruble, or let's say, not the Russian ruble, but let's give a specific example, South African rand. Okay. And let's say today, $1 is 20 South African rand. And when you go to the United States, you will see the prices in United States dollar. And let's say you want to buy a trousers, and there the trousers is approximately, let's say, $7. If the trousers is $7 for the South African guys, they will convert those 7 with their exchange rate, because $1 is 20 South African rand. Then they will calculate this. One trouser, according to my currency, is 140 rand, right? Then they will compare these prices with the South African trousers. And this exchange rate try to build up a competitiveness of the internal and external sector. So if the South African guys see that $7 trouser is cheaper according to South African rand, then he will buy in the United States. But if it is cheaper in the South Africa, then he will just buy everything in South Africa. So this competition coming from the real effective exchange rate and low of one price. Low of one price, meaning that the exchange rate will make equal all the prices around, like a Big Mac index. And the nominal exchange rate pass-through matters for inflation. So real effective exchange rate is just a demand for the competitiveness, but the nominal exchange rate that we see on the screen and television and on the street will affect the inflation via the pass-through channel. Okay, from the exchange rate, we will pass to the inflation. And if you see this exchange rate channel, the real effect. The real effect is coming from, given the price stickiness, because prices are sticky, they are not moving easily and frequently. Change in the nominal exchange rate lead to change in the relative price of domestic product and foreign products. Yes, if the 1 barrel of the petroleum products is today $83, and if the rand is just 20, meaning that 1 barrel is 1,600, according to South African rand. But despite no change in the prices, again, the price barrel is $83. But If the South African rand depreciate from 20 to 30, now one barrel will be 1,800 rather than 1,600, and prices will go up. Despite the energy prices the same, please be careful. Price of the gasoline not changing. Just because your country's currency depreciating, the inflation and prices is going up because of the exchange rate effect. Consider a depreciation of the domestic currency that I gave the example. In the domestic market, this tends to lead to expenditure switching away from foreign goods and towards domestic because the international products will be higher for you. It is expensive and you will convert your international demand to the domestic demand. In foreign market, domestic firms gain competitiveness. Yes, because nobody will demand any international product. And because the demand will increase the domestic product, domestic firms will gain the competitiveness in the market. But both effects depend on pricing strategy of the import and export firms, plus import intensity of the domestic production. And second channel, the interest rate channel. The interest rate channel here try to explain this central hypothesis. The central bank has control over short-term nominal interest rate, right? At the beginning, we say that the central bank always is the highest authority who can decide the money supply and interest rate. Nobody can ask and question this because they are the highest authority to determine the interest rate and money supply in the market. And central bank, this short-term nominal interest rate through the management of the liquidity condition. This almost is called generally as open market operation. Open market operation generally known as repo and reverse repo transaction. So if the central bank buy the government bonds from the market and give the money, this is repo. Then if the central bank sell the government bonds and take their money back, this is the reverse repo transaction. Okay, you should keep this in mind in this style. The OMO, the open market operation, is two-sided. One is the repo, and the second is reverse repo. Repo means repurchase agreement. So if the central bank want to increase the money supply in the market, they will buy the government bonds and they will give money in return to the market, and money supply will increase in the market. Or if they try to decrease the money supply, they will make the reverse repo, like today Fed doing. What is the Federal Reserve Bank of United States doing? Fed. They are making the reverse repo transaction. Why? Because there are huge money in the market after the COVID crisis, and they try to collect their money back to the Federal Reserve account. So they are selling the government bonds at their hand, and they are taking their money back, and money supply decreasing. Because the money supply decreasing, inflation is going down. As you see here, this gives it some influence over long-term interest rate in both nominal and real terms. Because if I'm making an open market operation in the market, this will affect not just the short-term loan, but also affect the long-term rates in the market, like the 10-year, 30-year treasury bond prices. And the long-term real interest rate matter for aggregate demand. So if Dr. Walchin knows that in the near future, prices will go down, Dr. Walchin will not buy anything today because he knows that if he buy tomorrow or 1 month later, he will buy cheaper. Okay, so long-term rates will affect the inflation expectation and overall economic condition. And the third one, this is the credit channel of the monetary policy transmission mechanism. Here, the central hypothesis is this: bank lending, because banks also lend and borrow the money from the market, like, right? For instance, as a let's say Hortensio Ismail go to the banks. He is borrower and bank is lender. But sometimes if the Ismail have excess money in their pocket, he open a deposit account. Now he lent the bank and bank is borrower now. So this mechanism working mutually on the banking and household side. Bank lending depends on the interest rate because the cost of money is everything for the banking sector. Interest rate is the cost of money and on the economic condition more generally. So despite the interest rate, the banks also, while giving credit, giving loan, also focus on the economic condition in the near future. If they have pessimistic on the near future, they will not give any loan to the market because those loan will be converted as non-performing loan into near future because nobody can pay those money back because economic condition is not good. Nobody can pay those money back to the banking sector. So interest rate and overall economic condition will affect the bank lending channel. And more important case is this. Monetary policy affects the economic condition, right? Look at here. Banks focus on economic condition and monetary policy affects the economic condition, which amplifies its direct effect on bank lending via interest rate. So if I change the interest rate, if it will affect the bank lending channel, then it will affect the economic condition in the near future. So these are two linked cases. Interest rate affect the lending channel and lending channel affect the overall economy. And at the end, we will affect the inflation rate, the prices. And the credit channel, you should keep in mind this credit channel in this version. Two mechanisms amplify the direct interest rate effect on banking lending. Policy tightening, meaning that interest rate increasing and money supply decreasing. Policy tightening is this. Policy tightening tends to reduce the net worth of the businesses and individuals, making it harder for them to qualify for loans at an interest rate, thus reducing the spending and price pressure. Balance sheet channel, meaning that if I am making the policy tightening in the market, if the interest rate is going up, this means that in near future, prices will go down because of the monetary policy balance sheet channel. It is coming from the credit channel. And secondly, policy rate hikes also make banks less profitable in general and thus less willing to lend. If the interest rate increasing, banks have lots of government bonds at their hand. Okay. And if the interest rate goes up, prices of bond goes down. And if I holding bonds, I will have a net loss because prices of bond going down as a bank. So I will be lose the money and I will not willing to give the credit more. And this will result in credit crunch in the market. And the last one, the last channel is asset prices channel. Here is the central hypothesis. Monetary policy influences asset prices through its management of the liquidity condition. Okay, asset prices can be affected by a liquidity condition. Asset prices, these are all things, real estate prices, stock prices, even crypto prices, these are all assets, gold prices, these are all assets. Okay, and these prices can be directly affected via the liquidity channel in the market. An asset price, especially real estate and equity prices. Okay, real estate is your houses, and the equities are the stock exchange, like Amazon, Apple, Microsoft in the Nasdaq. The asset prices affect demand through private consumption and business investment. And they also impact the balance sheet of the banks and businesses, right? They can affect the prices of stock and prices of real estate of private household. This is private side. And they also affect the business side via the balance sheet channel. So at the end, the asset prices affect on household consumption. As you see, equity and real estate prices affect household wealth, because if your prices of the household going down, the real estate prices going down, I have less money and inflation will go down. And household borrowing capacity. If the prices of the money is higher, my capacity of borrowing will be decreased because I will not borrow the money with higher prices in the market. And my price for money decrease and the inflation will decrease at the end as well. So this is